Hello, and we are live. Thank you very much for joining me. My name is Mitch Goldberg. You're watching a live episode of Be the Boss of Your Money, your place for perspective about personal finance, investing, and business. The whole point of this is for you to become the boss of your money, not your money to be the boss of you. My goal with this is to help you become the best possible financial version of yourself that you could be. The value add today: do tech stocks have a weight problem? We've been talking about this here and Be the Boss of Your Money for a very long time, that tech stocks get bigger and bigger and bigger, and your FANG plus M stocks are taking up close to 30% of the S&P 500. Tech stocks continue to get bigger, and it gets to a point where maybe they're just too big. So what we're going to do is we're going to roll the introduction. We're going to do a quick market review with perspective to put it all onto a page that we can all read from, and then we're going to get to the value add. So you're going to want to stick around for this, and I'll see you on the other side of the introduction. Here we go. Okay, here we are. We are back. Are tech stocks too big a portion of the market? Do tech stocks have an overweight problem? My own point of view, personally, what I think, and I think that's one of the things you come here for, is because you expect me to have a point of view, right? Not just to give some vague, well, they could be overweight, they might not. No, you know what I think? I think they are. I do. I think they are definitely overweight, and it's something I worry a lot about, and it's something that I talk about a lot right here and Be the Boss of Your Money. Now, if you're watching this in the live stream, I see you out there, Matt, Stacy, thank you so much. Go ahead, hit me up with any questions you may have. I'd love to see your questions. I'd love to give you the answers, or at least direct you to the best answers. I love the interaction, the dialogue. If you're watching this in the replay, I'd like to welcome you also. Certainly ask any questions in the comments, and I will be sure to keep an eye out for those. So Matt is out there. I usually save the comments for later, but Matt has a comment / question. Is Santa overweight? Might be a parallel. Might be. Maybe it's telling us it might not be such a great Christmas shopping season at this rate. Think about it. Can't go to the malls. People are worried about job security. And the federal unemployment benefit of $600 per week is about to be sharply curtailed. I was going to talk about that at the end of the show, but I'll talk about it right now just because I feel like I'm meandering over there. So, we've had this $600 per week for a few months now. It expires this weekend. Okay. For most people, it expires at 26. It depends on what state you live, or it could be the 30th. But it's coming off in about a week. And now Congress is debating over it. The Senate is debating over it. They've had months to decide what to do next when the $600 per week rolls off. My recommendation would be just go down to $500 per week for the rest of the year, and then after we get into 21, knock it down to $400 per week, and then in the middle of 2021, knock it down to $300. At least we have ourselves covered for the next year and a half, and we don't have to have these crisis management meetings every couple of months. It's just a terrible way to govern. I think we could all agree with that we all have to do things in advance. If you're a business owner, if you're running anything, if you're raising a family, you know how important it is to plan and to do things in advance. Okay. So let's just take a look at here. I want to get to the value add now. Are tech stocks too heavy? Do they have a weight problem? You like the seesaw with the elephant? Okay. The tech stocks have and the scale over here. All right. I am getting really good with my art. So let's do a quick share screen, and I'm going to talk to you about a couple of things. We're going to wrap this up pretty quick. Somebody referred to Thursday, which right now it's Thursday the 23rd, as Thursday is just Friday Eve. I kind of like that. It just makes the whole day better all of a sudden when you change your mindset. The Dow, finally a down day. The Dow down 350 points. S&P down 40 points. Percentage-wise, just about as bad as the Dow. NASDAQ down almost 2.3%. And the Russell 2000, the only standout, but barely up. And the VIX was up. The VIX is up 7%. Okay. Normally, you would see the VIX go up when the S&P 500 goes down because the VIX is a worry gauge. So markets go down, worries go up. So you expect the VIX to go up. The VIX is just telling you that professional, money managers, hedge funds, traders, they are paying more money to hedge their portfolio in anticipation of what could be volatility, i.e. down market. So what was the cause today? We've just got to take a quick look here then, just to give you some aftermarket action. Intel came out with its quarterly numbers. The stock is down almost 9% on Intel. Now, Intel's been doing well lately, and that's been another stalwart of the technology cohort, which people don't really talk enough about Intel. But Intel down over 8%. And in the regular session, Tesla, which had a blowout number and was way up in aftermarket trading last night, wound up finishing the day down 5% and just went negative in the aftermarket trading. But in the regular session, okay, Tesla's down 5%. So, and that they came out with a great quarter and a really solid forecast going forward, and the stock still went down. What does it tell me? Tech stocks are tired. Investors are tired. It means that there's really not enough new money coming off the sidelines to fuel the same old stocks. So we'll talk about that more, and I'll make the parallels to the year 2000 and see if we could come to a conclusion. You take a look at some of the big winners and losers. Huntington Bank shares, United Airlines was up, Under Armour was up. Under Armour is such a low price stock. Well, look, Under Armour's over 10. Twitter had a really good day, up over 4%. Halliburton was up a little bit. But in the downside, you rarely see this, but in the downside, Chipotle was down, but Apple, Microsoft, and Amazon are in the bottom performers all at the same time on the same day in the S&P. That's not something you see too often. Let's take a look at the sector ETFs. Consumer staples, utilities were up. Financials held up okay. That's pretty good that financials held up pretty well today, considering that we've got unemployment numbers that came out today that were worse than expected. We just had the 18th week in a row of 1 million plus first-time unemployment claims. It's pretty serious stuff. And now with the rollbacks and the phases of reopenings in a lot of the Sunbelt states, Texas, Georgia, California too, and so it's in the West. Okay, so that just tells you that we expect the unemployment picture to get worse again. How much worse? I don't think it'll be as bad as it was 3-4 months ago with something like 40 million unemployed people. But right now, the unemployment rate is about 11.3%. We're going to get those numbers out 2 weeks from tomorrow. We're going to see what the July report looks like, and that'll give us a really good indicator of how the reopenings and the economic and the employment is working out. All right. And at the bottom, of course, as you'd expect, tech down a lot, communications down a lot. By the way, the XLC, the tech, this is the big communications sector ETF from State Street. This is the spiders. I follow 11 sectors using ETFs, all from, the spiders ETFs, well-known sector ETFs. And just so you know that this XLC is, it's about 50% Alphabet, Google, and Facebook. And I always like to say, what's the point of having an ETF if half the portfolio is in two stocks? Netflix is in there too, so that's another couple of percent, okay? So it's just been overall, the only saving grace I can find is that financials held up pretty well today. I'm not really overly sure why financials held up so well. I didn't really see anything great. Interest rates are holding low. In fact, the 10-year Treasury continues to remain low and go lower. Let's move on. Fang M. So these are the stocks. I talk about Fang M. That's Facebook, Apple, Amazon, Netflix, G for Alphabet, and Microsoft. So Fang M. These 6 stocks count for almost 30% of the S&P 500. I always say this, if you've been a watcher of the show, when these stocks move, they're like the black hole in outer space. They suck everything up or they suck everything down. You just can't escape the gravitational pull of these 6 stocks. And when they're all down, and I don't mean just down, but they're down a lot today. All 3%, 4.5% on Apple. I mean, the best performer of the FANG stocks is Netflix, and that was only down 2.5%. The worst one was Apple, down 4.5%. Listen, these stocks have had tremendous runs, so it's not a disaster that they're down, but the fact that they were all down so much today just tells you that there's no way the major averages are going to really escape this. Yes, I know the Russell 2000 small cap index was up a fraction of a percent. Why was that up? Just maybe investors perceive that as a somewhat still cheap, inexpensive value proposition to be in. Microsoft had a slowdown in their advertising. Microsoft, their Bing search engine, had a slowdown in advertising spend. They saw that, and that's probably bad news for Google, which is about 85% of the internet search engine market share. Okay, so let's get to the heart of the matter, and then we need to make a decision. I think tech stocks are too big a portion of the overall portfolio. The counter to that is this is not 1999 when you had ridiculous valuations, because if you look at these top tech stocks, Microsoft, Amazon, these are great companies. These are financial miracles what these companies have been able to do. Actually, I get that term financial miracle. It's from Warren Buffett. He actually used that term to describe Amazon as a financial miracle of what happened. So are they too high? Listen, when these companies come out with decent numbers, and Microsoft came out with some decent numbers, and they still go down, yes, it gets to a point where you could be right on the fundamentals and still wrong on the price of the stock, just because the stocks are up so much. Money managers, investors, professional investors, retail investors alike are concerned about the economy. And if you want to raise cash, where are you going to take it from? Maybe you want to protect your giant gains in these stocks. And once these stocks do start to go down, then other investors will see that and say, I've got too big of a gain in these stocks. I better protect it, because it's the only thing that's saving me. I mean, every investor, from us, the retail investor, to the big institutional money managers, we're all relying on the same, 10 or 15 stocks. You could throw in a Salesforce.com, you could throw in a Tesla. Everyone's just going by the same stocks, though. And that's where the danger comes in. Is it a danger when the breadth of the stock market is so bad, meaning that so much rides on so few stocks? So I want to take a look at what Goldman Sachs says. And it's something that we've been talking about, so it's good to see someone else talking about it. So Goldman Sachs sees risks for investors as the biggest stocks take over the market. This is not a new story, that eventually there will be hell to pay for all the stimulus and for all the money going to the same big stocks. But a couple of points that Goldman makes, okay, is that if the top stocks, the top 5 companies go down, that's Facebook, Amazon, Alphabet, Microsoft, Facebook, Amazon, Alphabet, Microsoft, and Amazon, Facebook, Amazon, Apple. It's like a tongue twister. Okay, so it's the biggest 5. So we're excluding Netflix, which would be number 6. Okay, but if those stocks go down 10%, in order for the S&P 500 to hold up, the bottom 100 stocks would have to go up 90%, so almost a double. What are the odds that the bottom 100 stocks in the S&P 500 double? I think the odds of that happening are extremely low. But what are the odds that we could have a 10% correction in the largest stocks? averaging out a 10% correction between them. I think that's a possibility. We've seen that before. So therein lies the risk that there's nothing else holding up the market. These companies are so big that if they go down, they hurt the market. Now, investors have been asking a long time, and we're right on time, folks. We're going to be over in a few minutes. Investors have been, if you have any questions, by the way, please ask away in the comments. I'd love to answer them. Investors have been wondering why the stock market has held up so well when the economy has done so poorly. It's because of the top biggest stocks in the S&P 500, FANG plus M. The Netflix, the big screen stocks. You could throw in other stocks like Activision, Take-Two Interactive, companies that keep you entertained that you look at your screen for. So these stocks have led the way. What's happening now in the pandemic and the economy, it's like custom tailored for these big tech stocks. So not only are the big tech stocks going up, but this environment actually helps them because of the work from home, stay at home, conditions that we have. So if they come down, what rescues them? I've even said before, about a week ago, 2 weeks ago, maybe, I said, look, if we actually do come out with a vaccine for COVID, the market, the economy could do well, and the stock market could do poorly. Because if you have the vaccine, let's say we get a workable vaccine in the next few months, which is a very daunting thing, but we're, fingers crossed. Okay. But it would take away the impetus to own these large screen stocks. And maybe that would mean money comes out of them. But where does it go? Yes, it could go into the industrials. It could go into the airline stocks, the cruise lines, casinos, mall operators. But will that be enough of those stocks going up to counter a substantial retreat in the largest stocks? And therein lies the risk that we really don't have the level of diversification in the S&P 500 that we used to have. This is not the first time where the biggest stocks have dominated the index, but in the past, when that has happened, it's usually a very painful period for investors when we find a new group of stocks to lead the index, a new set of generals. AT&T, ExxonMobil, IBM, these used to be the biggest companies in the world, and look what's happened to them. So it takes a while for new companies to come in. During the peak of 99, 2000, Microsoft is the only stock that has been able to stay in the top of the pack. All the others came lately. Facebook wasn't around yet. Google wasn't around yet. Netflix wasn't around yet. Amazon was still a baby, and that stock did horribly in the tech wreck of 2000. Microsoft was a winner, but it took like over 10 years, maybe 12 years for that stock to get back to its 2000 high, more than 10 years. So it's a very painful process to rotate into new generals. And because of the lack of diversification in the S&P 500, that we don't really have anything else to rely on. The point of diversification is diversification is not supposed to be a money-making endeavor in a way. It's not. Diversification is not a strategy to maximize returns. Diversification is a strategy that we use to help minimize returns. It doesn't necessarily prevent your portfolio from going down in a generally down market, obviously, but diversification by its very nature prevents you from doing as well as you can with a concentrated portfolio, because you have good and bad in a diversified portfolio. But when you have the kind of market we're in, where it's filled with so many so few hot stocks taking up all the room, and so many cold stocks taking up not enough room, it really kills the point of diversification. And when you're not diversified, which means you're over concentrated in a particular area, if that area does poorly, not only do you suffer, but it magnifies your suffering because a bigger portion of your portfolio drops. And if you look at like ESG funds, which I talked about 2 days ago, if you look at almost pretty much any large cap fund, they're all dominated by tech. So you could even think that you are diversified, but there's a really good chance between your small cap, mid cap, and large cap that you've got a very big slug of technology stocks across the board. This is why you really need to look under the hood. It's kind of a reason why it's good to work with a financial advisor to help you figure these things out. Just a shameless plug, but if you do have any questions for me, I'm here to answer them. And that's about it. So that's my story. I'm sticking to it. I'll be back Monday. On Fridays, I send out a blast email. It's really good. It's really unique. It's pretty heavy stuff in there. And that's about it. I will speak to all of you Monday. Have a great weekend. Thanks so much for being out there, Matt, Stacy, Judy. I always get the heart from Judy. Love you, sweetie. And there's a few other people watching. I don't know who else is watching, but I could tell there are other viewers. So I'd like to thank you as well. And I will speak with you soon.